Rate cuts and AI regulation are about to collide in the same week, and this time the market won't just move, it could snap in a single direction without warning. Hey guys, I'm Peter. Today is Tuesday, December 9th, 2025. On the surface, the three major US indexes only pulled back slightly, but quiet markets often hide the biggest turning points. The FOMC decision is coming tomorrow. A 25 basis point cut is already priced in. The real reaction depends on what Powell says, not the number itself. Funds are not panicking, they're waiting. 10-year yields have been climbing again, which explains why tech softened lately. Not because growth is fading, but because investors want room ahead of the announcement. If Powell sounds hawkish, we'll likely see volatility before direction. If he's soft, risk assets could burst upward. The more subtle point, Powell is nearing the end of his term. Markets are slowly shifting focus to asset and the incoming policy tone for 2026. So this isn't weakness, it's breath holding. Institutions don't push hard before visibility returns, nor do they dump unless structure breaks. For retail traders, the worst thing you can do now is chase every hour's fluctuation. The right move is to mark key levels, wait for confirmation, then follow tomorrow. Indecision ends, movement begins. Now, the second catalyst, U.S. AI policy. Trump has already signaled a federal-level AI rule, replacing the messy 50-state split regulatory model. From now on, compute deployment, model approval, and data compliance could run under one gate. Large-cap players gain clarity and scale. Weak players lose room to hide. We have officially entered AI Phase 2, regulation, not chaos. This isn't a break, it's filtration. AI winners won't be the fastest talkers anymore, but the ones who can survive compliance cost, transparency, responsibility, and capital burn. Plenty of AI tickers pumped on narrative in 2024-2025 under unified regulation. Only those with compute, customers, training pipelines, and real infrastructure will remain. Story-only names won't. Now, NVDA, Semaphore reported H200 export flexibility may expand. The stock spiked intraday, then faded, because investors want official confirmation. If approved, US regains leverage while monetizing tech dominance abroad. If not, the rally was a positioning test, not the start of a new leg. Short-term is headline-driven. Mid-term depends on policy text. Long-term depends on AI infrastructure spending and order visibility. Technically, NVIDIA reclaiming above its monthly moving average shows selling pressure is digesting. Next, watch the 50-day break above. 200 plus becomes realistic target, fail repeatedly, then it drifts in consolidation until the next policy or earnings catalyst. We aren't predicting direction, we're waiting for confirmation. We also have earnings catalysts. Oracle reports Wednesday after close, Broadcom Thursday after close. One reflects enterprise cloud demand, the other reflects bottom-layer compute, AS size, and network build-out. If guidance stays firm, Wall Street extends the AI cycle into next year. If tone is cautious, high-valuation AI names may correct to reprice expectations. This week is not about price, it's about forward language. Another signal, breadth. The S&P 500 equal weight index hit new highs before the main index. That means rotation is real, not just 7 megacaps pumping markets alone. Healthy rallies widen, not narrow. And widening is exactly what we're seeing. But the more consensus believes it must go up, the more we must sell the news risk. Markets often rally into expectation, then pull back on confirmation, not because it's bearish, but because early money cashes out. A bullish trend requires fresh buyers replacing profit takers. Without that, even good news dips first. Key S&P zones are clear. Above 6,920 equals breakout next expansion zone 7,168, 7,210. Fail and lose, the 50-day equals watch 6,500, 6,550. We aren't fortune-telling. If it breaks, we follow. If it rejects, we hedge. If it ranges, we observe. The market answers tomorrow. The Nasdaq story is different. A gap remains unfilled, not weakness, but compression. If large funds wanted, they could close it in a single session. They haven't, because closing means confronting resistance, triggering profit-taking and inviting shorts. The slow grind is intentional. Shake weak hands first. Gap fill is inevitable, but post-fill strength determines trend. Lose the 50-day, momentum flips. Individual names now. CoreWeave is issuing 2 BS convertible notes plus a 300 MS expansion option. 1.5%, 2% coupon, cheap capital, good for the company, dilutive for equity holders. Pre-market dropped. Intraday recovered, meaning funds are okay, with dilution for growth. Index reshuffles bring real flow. Carvana, CRH, and Fix enter the S&P 500 on December 22. Passive funds will buy. That's mechanical. Stocks being removed. They get sold. Also mechanical. Inclusion equals long-term inflow. Removal equals structural selling. Often no news needed. Flows alone move price. Media tickers heated up after Paramount and Skydance offered roughly $30 per share for Warner Bros. Discovery. A former U.S. administration figure commented that if additional streaming players joined the bidding, the situation could shift quickly. Chip second-to-order tension equals Marvel. Bichember downgraded from buy to hold, warning Amazon may shift next-gen Trinium design toward Taiwan's Alchip. Growth estimate potentially easing to 20% in 2026 that contradicts Marvel's previous no-order loss tone. When institutions disagree, volatility increases. This is repricing, not collapse. Meanwhile, Broadcom keeps climbing structurally. Microsoft co-development talks signal compute supply diversification away from NVIDIA. IBM negotiating a 11B's acquisition of Confluent confirms that real-time data pipelines are the fuel lines of AI. Models are engines, but fuel lines control flow. Whoever controls data ingress controls monetization. Clean energy. Northeast E-locked multi-GW deals with Google and Meta, raised future earnings and dividend growth. Stocks spiked pre-market, closed lower. A classic priced and flush, not bad news, just digestion. Heavy asset energy names move slow, trend slow, realize slow. Pullbacks reload momentum, not break trend. If tomorrow is dovish, cyclicals may lead first. Banks, industrials, energy, tech follow second after rotation settles. But if tone is hawkish, tech takes first hit, yet real danger is not the drop, but whether anyone buys the drop. Right now, dip buyers still exist. The structure bends, not breaks. Direction matters, but execution matters more. We don't guess outcomes, we respond to confirmation. Brick ride, fail protect, range wait. The goal is not to be early, but to be right. Markets reward those who react with clarity, not those who gamble on prediction. AI regulation will reshape the industry over years. More disclosure in model training, clearer responsibility, higher data transparency, mandatory audit trails, short-term friction, long-term acceleration. Regulation builds highways, chaos builds crashes. This is the turning point where AI becomes infrastructure, not hype. H200 export is not open or closed. It's valve-controlled limited approval. Revenue share, approval tiers, that's strategic flow management. The U.S. does not want to lose advantage, but wants leverage via controlled access. The question isn't will it open, but how it opens. For investors, portfolio segmentation beats prediction, trend positions follow macro trading positions exploit volatility, defensive positions protect capital, markets are survival, not perfection, those with stamina, not brilliance, survive whole cycles. Over the next week, institutions will do 3 things: watch rate tone, watch AI earnings tone, watch post-reaction strength. If price confirms direction, follow. If not, wait. Calm water is not weakness. It's pressure building. Storms choose direction, not us.